Welcome to the deep dive. Now, if you're following the markets, you know the daily expectation is for, well, volatility. But today, we're breaking down a market where the main theme isn't just price swings, it's something deeper.
It really is. We're talking about structural maturation, about resilience in the face of some major uncertainty.
Exactly. Our mission today is to cut through that noise. We're going to synthesize all these complex macroeconomic signals, the on-chain data, the regulatory stuff, and really give you the signal you need.
And the core tension here is fascinating, right? How is Bitcoin managing to defend that $92,000 level?
Yeah, at the same time that traditional stocks are flashing these, textbook recessionary signals.
It's a huge shift.
Yeah.
You think back to previous cycles, and any sign of economic trouble, a bad jobs report, crypto was the first thing people sold.
The first asset out the door.
Without a doubt.
Yeah.
And what we're seeing now is this distinct decoupling. Bitcoin isn't just being treated like a risky tech stock anymore. It's getting deeper into the global financial plumbing, and that's largely because of this huge influx of institutional money.
Okay, but let's be realistic here. The path to that big $100,000 milestone, it's not a straight line up.
No, not at all. You've still got major headwinds. The Fed is still a huge question mark, and you've got regulators getting tighter all over the world, so it's a complicated picture.
All right, let's dive right into that technical battleground then. If we're talking resilience, what are the actual levels we need to be watching right now?
It's a really tight range. You have this very firm support building up at $92,000, and then right above it, stubborn resistance at $94,000.
And that 92K support, that's not just a random line on a chart.
No, not at all. If you look at the order books, it's a clear zone of institutional accumulation. The big players are just absorbing any selling pressure that comes in. They're what we call diamond hands. They see a dip, they buy it.
So, okay, if the institutions are defending the floor, what's holding up that $94,000 ceiling? Is it just retail traders taking profits?
That's part of it, for sure. But there's a much more powerful dynamic at play, and it's coming from the options market.
Ah, okay.
Yeah, we've got a major options expiry coming up. And the level where the most contracts expire worthless, what traders call max pain, that's sitting down at $90,000.
And usually, price tends to get pulled towards that max pain level as we get closer to the expiry date.
Exactly. Market makers love it when options expire worthless. But here's the bullish twist. Bitcoin is trading above 90K.
Right.
And that introduces this bullish divergence. It puts pressure on the market makers who sold those call options. They are forced to buy spot Bitcoin to cover their risk. It's a process called delta hedging.
So that delta hedging, for you listening, it basically creates a kind of a natural floor of buyers.
That's the perfect way to put it. It's a natural bid. The derivatives market is basically creating demand for the actual underlying asset, and that helps prevent a collapse down to 90,000. It's a structural buffer.
Okay, so that brings us to the decoupling moment. We got that U.S. private payrolls report, and it was a shocker. A contraction of 32,000 jobs.
A classic recessionary signal. And TradFi, the S&P 500, the NASDAQ, they reacted exactly as you'd expect.
Sold off immediately. Everyone went risk off.
Right. But Bitcoin didn't. It stabilized. It held that $90,000 to $92,000 zone. It did not follow the other risk assets down.
And that's the aha moment. The market is fundamentally changing how it values this asset.
It is. The market isn't just pricing it as a high-risk tech stock anymore. It's starting to price it as a potential hedge against, monetary instability.
Let's really nail that logic down, because this is a huge deal. You're saying the market is looking 2 steps ahead. It's not pricing the recession, it's pricing the response to the recession.
Precisely. The logic is completely inverted now. If the economy is getting weaker, what's the Fed eventually going to be forced to do?
Stimulate. Print money.
Exactly. Debase the currency. And since Bitcoin has that fixed, unchangeable supply, bad news for the economy is increasingly seen as bullish news for Bitcoin's fundamental value. It's becoming that hard money hedge.
And you can see that structural maturity in the sheer amount of money pouring in. If we shift to on-chain data, Glassnode's numbers for the cycle are just staggering.
They really are. We're talking about $732 billion in new capital.
Wow.
Yeah. New money absorbed this cycle. And it's almost all coming through those U.S. spot ETFs.
Hmm.
To give you some context, that's bigger than the entire market cap of some major global banks.
So what's the real implication of all that institutional money coming in beyond just propping up the price? We hear a lot about it taming volatility.
And it absolutely is. This is the crucial part. This money is completely different from the retail-driven, high-leverage money from past cycles. Institutional capital moves slower. It's stickier.
Right. Less panic selling.
Far less. And it has structurally crushed volatility. 1 year realized volatility is down by almost 50% compared to previous cycles. And what that does structurally is it makes Bitcoin eligible for a whole new class of investor. Think pension funds, endowments. They couldn't touch it before because of the volatility. Now they can.
And speaking of that conservative capital, you have to talk about BlackRock. I mean, Larry Fink's complete 180 on this is something to behold.
It is. He went from calling it an index of money laundering to, well, to his current position.
So how much of that is a genuine belief versus just, marketing for their huge IBIT ETF?
I think it's a mix, of course.
Yeah.
But the language he's using suggests a real deep structural belief is forming. He's framing Bitcoin as a legitimate asset, like gold, but with better utility because it's digital. But the most interesting part is his focus on the tech itself.
The tokenization angle.
Exactly. He explicitly says Bitcoin's technology is the foundation for the tokenization of all assets. He's not just thinking about an ETF. He's thinking about reinventing finance.
So BlackRock's endgame isn't just collecting fees. It's using this infrastructure for everything. Stocks, bonds, real estate.
That's the vision. A world where all these assets are tokenized on a digital ledger, settling instantly, 24/7. And in that new world, Bitcoin isn't just an investment, it's the pristine collateral. It's the anchor of the whole system.
And this tokenization of real-world assets, or RWAs, this isn't some far-off sci-fi concept. It's happening now.
It is. It's very tangible. We already have $24 billion of RWAs on-chain, mostly U.S. Treasury bills. And this is so important because it creates a utility floor for the market that has nothing to do with speculation. It's capital looking for efficiency, and that creates real fundamental demand.
Okay, so if BlackRock and the institutions are treating Bitcoin like the new digital gold, how does that hold up when the Fed itself is throwing so much uncertainty into the mix?
That is the single most important external variable. And Fed Chair Jerome Powell, he just gave the market a huge dose of that uncertainty. He used this analogy of driving in a fog.
Meaning he has no idea what's coming next.
Pretty much. He pushed back really hard on the idea that a rate cut was a sure thing, saying a December cut is far from a foregone conclusion. The data is just too conflicting. Inflation is sticky, but the labor market is cooling fast.
And the market reacted instantly. Those December rate cut odds, they went from almost 90% down to, what, 67%?
Just like that. And the fact that Bitcoin held 92,000 through that hawkish shift just reinforces this whole decoupling idea we've been talking about.
It really creates a split in how the experts see this playing out.
A huge split. You've got this whole spectrum of opinion now on what's actually driving the price. Is it rates? Is it liquidity? Or is it just pure, simple scarcity?
Okay, let's break that down. Start with Kevin O'Leary. He's on the more conservative, scarcity-focused side.
Right. O'Leary basically says, forget about trying to guess what the Fed does next quarter. He argues that even with small rate cuts, if inflation stays around 3%, your real yield is still pretty high.
So rate cuts don't matter as much as people think.
That's his argument. He says, just ignore the noise. Focus on one thing, the 21 million hard cap. For him, that scarcity is the only thing that really matters to the long-term institutional buyer.
And then on the total opposite end of the spectrum, you've got Arthur Hayes with his hyper-bullish $200,000 target. He's all about liquidity.
Completely. Hayes makes this brilliant distinction between the price of money, that's the interest rate, and the quantity of money, which is overall liquidity in the system.
Okay.
He argues that because of huge government deficits, the U.S. Treasury has no choice but to flood the system with liquidity through things like the TGA and reverse repo facilities.
So just to clarify for everyone listening, when cash moves out of those accounts and into the banking system, it's basically like turning on the money printer.
It's functionally the same thing. And Hayes believes Bitcoin is the world's most sensitive barometer for that systemic liquidity. He thinks the money printing is just inevitable. And that's what drives us to 200K, regardless of what Powell says about rates.
So we have these two completely opposing views. One is all about fixed supply. The other is all about expanding liquidity.
And then you have a third view, a sort of sobering middle ground from the veteran trader Peter Brandt.
He's challenging that immediate supercycle idea.
He is. Brandt says, look, 200,000 is possible, but maybe not until, say, Q3 of 2029.
Wow, that's a long way off.
It is. He's looking at past cycles and saying the market needs a much longer consolidation period to really absorb all this new institutional money. He's basically pouring some cold water on the idea of immediate parabolic gains.
Let's shift to how companies are adapting to this new landscape. MicroStrategy is a fascinating case. They're moving beyond just buying and holding.
Yeah, Michael Saylor is evolving his strategy. He's now talking about what sounds like a Bitcoin bank model.
A Bitcoin bank.
He's proposing ideas like generating yield on their Bitcoin by lending it out, or using it as collateral to fund things like dividends for MSTR shareholders.
And that directly tackles the biggest criticism of Bitcoin, right? That it's a non-productive asset that doesn't generate cash flow.
It's a direct response to that. For years, big institutions said they couldn't hold it because it doesn't pay a dividend. By finding a way to make it productive, Saylor is creating a blueprint for other corporations to put Bitcoin on their balance sheets.
And at the same time, they're building this massive defensive wall.
An absolute fortress. They have a $1.4 billion cash reserve. And that's strategic. It means they can pay all their bills, all their debts, without ever being a forced seller of Bitcoin, even in a major crash. It's a huge stabilizing force.
Let's talk about utility. A big Ethereum upgrade, Fusaka, just went live. Why is an Ethereum upgrade important for you as a Bitcoin holder?
It's hugely important because of wrapped Bitcoin, WBTC. The tech in this upgrade, something called PeerDAS, it's a game changer for efficiency.
How so?
After the upgrade, Ethereum hit a record of nearly 33,000 transactions per second. That's Visa-level throughput.
Okay, that's fast.
It's very fast. And since so much Bitcoin is locked on Ethereum as WBTC to be used in DeFi, a faster, cheaper Ethereum makes using your Bitcoin for things other than just holding it way more attractive. It drives real utility-based demand.
We also saw a big consumer utility step forward with Tria's new app.
Yes, this is a big one. It solves a major problem for actually spending your crypto. Usually to use a crypto card, you have to give your coins to a third party.
Which defeats the whole purpose of self-custody.
Exactly. Tria lets you spend your Bitcoin with a card, while the keys stay in your own wallet. A smart contract converts just the right amount to fiat, right at the point of sale. It's a breakthrough for real-world use without sacrificing sovereignty.
Finally, we have to touch on the regulatory landscape. It's still a messy patchwork. In the U.S., regulators in Washington state just went after a big Bitcoin ATM operator, CoinMe.
Yeah, this is a classic move against what you call the gray market. The regulators are alleging that CoinMe took over $8 million in customer money from unredeemed vouchers and just booked it as corporate income.
So accounting fraud.
Essentially, yeah. And it hints at insolvency risk. It's bad for that one company, but for the industry as a whole, taking out the non-compliant players is a long-term positive. It gives institutions more confidence.
And abroad, the enforcement is getting really high-tech. In Malaysia, they're using thermal imaging drones.
It sounds like science fiction, right? But they're using them to hunt down illegal mining operations that are stealing, estimates say, $1 billion worth of electricity from the grid.
So the drones just spot the heat from the mining rigs.
That's it. It's like a high-tech sheriff rounding up outlaws. And again, this is good for the network. It means the hash rate is secured by legitimate miners paying fair prices for power, which helps counter that whole energy theft narrative.
Okay, so let's try to synthesize all of this. It feels like a market with two very different stories playing out.
It really is. On the one hand, the bullish case is incredibly strong. You have that $732 billion new capital, volatility cut in half, major corporate adoption, real utility upgrades.
But on the other side, the bearish pressures are serious. You've got this huge macro fog from the Fed, Powell being hawkish, and real concrete recession signals like that jobs report.
Exactly. It's a tug of war.
So what's the final verdict on that $92,000 floor? Does it hold?
I think the structural maturation we're seeing, that decoupling from bad news suggests it does. The institutional moat is real. My advice would be to watch that 92K level like a hawk. As long as we're holding that, the primary trend is still bullish, and the next target is that $100,000 mark.
So here's the final question we should leave everyone with. Given that the price stood firm against both a major recession signal and a hawkish Fed, we have to ask.
Is it finally happening? Is Bitcoin truly becoming that macro hedge against central bank policy error? Or is it still just a slave to its own internal 4-year cycles?
And it seems like the evidence is pointing to a real change.
I think so. The structural maturity, the institutional money. It suggests that external liquidity decisions, like Arthur Hayes argues, might now be more powerful than those old internal dynamics. And that, right there, is a fundamental shift in the very nature of this asset. That's something for you to really think about as we head into the next phase of this cycle.